Welcome back to the podcast. It is May the 1st. I hear people are calling it Cinco de Mayo week. Did you, when people have birthdays, now they're calling it birthday weeks, and I guess bars are trying to get traffic. So I saw an advertisement for a bar saying, come for May the 5th, Cinco de Mayo, but it's Cinco de Mayo week. So I have Cinco de Mayo specials. I mean, this is the way. So this is the Cinco de Mayo week special of our podcast. And last week we had good feedback on the podcast I did with Benjamin Klein. We talked about the Canadian budget changes, what it means for your portfolio and estate planning. So please check that out. Prior to that podcast, Ernest and I did a podcast on waste connections. And just after that podcast, we had the earnings reports on waste. So we'll talk about that. And Ernest, what's going on with you? How's the family? Everything good?
Everything is good.
Good to hear. So why don't you talk about your meeting with a Canadian investment legend, one of the best Canadian investors of all time, Murray Edwards. Go ahead.
So yesterday I went to a company where Murray Edwards, the chairman of Canadian Natural Resources, was the chairman of this company, not Canadian Natural Resources.
So he's a chairman of a number of other companies. He's also a shareholder of other companies, and he was at this special meeting that you attended.
Yeah, I don't think he has kids. So he just spends all his time doing business.
Fair enough.
But anyways,
okay.
So he was the chairman of this company, and he was only there for 5 minutes. But I think in those 5 minutes, you can really tell that this guy, he's got it, right?
Yeah.
He's got it, quote unquote.
So for those who don't know, Murray Edwards, founder of Canadian Natural Resources, owns about probably $2 billion plus worth of Canadian natural resources, multi-billionaire, and Canadian energy investment legend. And our clients are shareholders of Canadian Natural Resources, of which Murray Edwards is a significant shareholder.
So there was a great story in the meeting where they were conducting the normal AGM type stuff, right? The election of the directors, appointment of the auditor, and those kind of things. And the company asked 2 employee shareholders of the company to do the motions, like this, I second the motion and those kinds of things, right? So the first one was this lady who was, I think she was the VP of sustainability. Then Murray Edwards said, "Okay, so what are we doing in that area of the business?" And she said, "We're doing great. We're implementing all these processes at our plants. We're doing ISO certification. Mm-hmm. There's this international standards board." And he said, "Okay, that's great, but how does that help us make money?"
So he's always about trying to make money. Well, we love investing with CEOs that only care about making money. That's the name of the game.
I think he was half joking, but then the poor lady, she's like, well, it helps us reduce water. It helps us,
for sure.
Doing good for the environment means we're doing good for society, which is good for our company. She didn't really know what to say.
And the audience, did it laugh? Did it? No response?
Well, there were only 4, I think 5 or 6 non-employee, non-board people there
at the meeting. Okay,
at the meeting.
Fair enough.
Funny thing about a lot of these smaller Canadian companies is that no one goes to the AGMs. Mm-hmm. They're mostly routine, boring kind of affairs.
Yeah.
But what's great is that if you go to these things, you can often get to meet people like Murray Edwards.
That's right. So Murray Edwards is not someone who does a lot of interviews. He certainly doesn't do podcasts. He's not an in-your-face CEO. There's no gatherings every May to go and see him. But you got to go right up close to him and ask him a few questions about, I'll let you do the talking.
Right. And so he went on a little rant about, this is public. He was doing, it's not like a private conversation with me, but he went on this rant about how Canadian Natural Resources, they pay more taxes, and including royalties, than a long list of these large companies like Royal Bank, pay more than Loblaws, Brookfield, CN Rail, right?
Yeah.
CNQ pays more taxes and royalties than all of those companies put together.
Even though it's the 4th largest market cap stock in Toronto, It pays more in taxes, more in royalties to the Canadian government than all those put together. Got it.
So they are funding a tremendous amount of social programs in Canada, right? But the government is just not willing to support this industry, even though it's creating so much value.
Yeah.
And then he said, as CNQ has said before, they could double production today if they wanted to, but they just have no way to move the product. So I think that's, I don't think this is saying anything new.
No, it's not.
But
And no, I mean, we all know that Canada has a tremendous amount of energy reserves. We're the 5th largest energy producer in the world. Are we taking advantage of all the reserves that we could be producing and growing the wealth of our country? Probably not, but there's offsets, and we're not here to be political and cause a stir, but obviously you could do the math and think about what would happen if we were producing all that much more reserves, or we had more LNG plants. Whether or not that's good for the environment, that's a whole other show. But he's absolutely right. Murray Edwards, the company, has created a lot of wealth for Canada as well as just shareholders, and it was one of our better performing stocks so far this year, as it's been a choppy environment. So we just finished April for our clients. April was a tough month for all markets, of course. Ernest, pullback in the markets after a very strong run since November. These kind of things happen. We're very proud, actually, of our relative results in April, but obviously you have a question, talk to your portfolio manager about it. So anything else Murray Edwards had to say?
No, but can we stay
Yeah.
on CNQ for a second?
Of course.
So I think it's today,
Yeah.
or either yesterday or today, is that the TMX pipeline expansion is starting, like this shipping oil.
So talk to everybody about what the TMX pipeline is.
And we're talking about, this is a project that's been a long time coming.
That's right.
It's probably one of the more important pipeline projects in recent Canadian history. It carries, so what the TMX expansion is it goes alongside the existing Trans Mountain pipeline that goes from about roughly Edmonton to Burnaby, BC.
Yeah.
And this pipeline currently, just to take a quick snapshot of the Canadian energy industry, the Canada, mostly in the West, we produce about 5 million barrels of oil per day.
Okay.
Historically, the TMX, the old one, it had capacity of about 300,000 barrels per day.
Okay.
The TMX expansion almost triples this. So the combined capacity today is about 890,000 barrels per day.
And shipping as of today, open for business.
It's open. It's open. I think it's not fully available. Not all of that is available, but it's shipping. Oil's moving through it.
Got it.
And this is a big deal in terms of Canada's ability to move oil from Alberta to other places like China or California, which is what this pipeline will allow.
Is this moving oil that has yet to be refined? Is it heading to refiners around the world?
This is largely of what the industry considers to be heavy sour crude. So
someone actually tasted it and said it was sour? Okay. Anyway.
So what that means is that it requires special processing.
Yeah.
The refineries have to be established to be able to process this crude.
That's right.
Refineries generally like processing heavy sour crude because it has higher margins. You can buy this oil for cheaper prices. It's a little bit more work to process, but they earn higher margins.
And you can sell it at the prevailing market price instead of it coming already sweet, the sweet crude that's coming from other nations.
Exactly. And so the hope is that once this pipeline is in full production, shipping properly, the differential, which is the price gap between Canadian heavy oil and the rest benchmarks around the world, namely WTI, West Texas Intermediate in the US, will narrow, which is great for Canada because they're making more money. So it's just something to call out. That's happening in Canada.
And for those that haven't been following these differentials, at one point they were as high as $30 difference.
Yep.
And the expectation is over time, it will narrow to a few dollars difference,
Yeah,
give or take.
Right now it's about 14, 15 US
Yeah.
per barrel.
Difference.
Difference, yes. The hope is that this will be under 10 when it is complete.
And the history, of course, of this pipeline is it was started by a public company, Kinder Morgan. It ran into problems, cost overruns. The Canadian government, Canada, you bought this from Kinder Morgan. More cost overruns, but it's finally in business. I think what will happen with the TMX pipeline is it will probably then be sold back to public companies or private companies from the Canadian government at some point.
So there was a little bit of an issue around the cost of building TMX, which I think is 3 times higher than originally budgeted.
Woo.
And that's a big deal because to cover the cost of the pipeline, they wanted to raise tolls.
Yeah.
And if the tolls are high, then the economics of shipping
Makes
to
no
other
sense.
places make less sense than it does before.
Yeah.
But I think I think that they'll probably figure it out somehow and make this work for all the parties involved.
And this is part of the reason why we got back into the Canadian oil patch, purchasing shares for our clients of Canadian Natural Resources and Tourmaline Oil, is the infrastructure is starting to be in place to get a lot of our stranded oil and gas into markets where we can get higher prices. That was part one of our thesis. It's slowly but surely playing out. One of the things, Ernest, we didn't see, getting off tangent, is just the enormous demands for electricity. And you can see it from the results from the big techs, Amazon and Microsoft and Google and Meta, all saying that they're going to spend over $200 billion this year, primarily on building infrastructure to support workloads for AI and data, which obviously require lots of electricity. And that's just this year, and one would presume more next year. Natural gas is a nice feeder stock for electrification. That may play out as well. So we'll see over time.
Should we say thanks to Trudeau
Why?
for helping us finally get this thing done?
Absolutely.
Yeah, I think he gets a lot of flack,
Yeah.
maybe deservedly so, for not being fully supportive of Canadian energy policy.
Yeah.
But it's done.
Yep.
And it's helping Canada.
Absolutely. Absolutely. I think, like we said, we have tons of reserves here. We have great infrastructure, great companies, great operators here. We should be taking advantage, obviously balancing the risks to the environment and social and governments. All those things are very, very important. We're not poo-pooing those things, but congratulations to the Trudeau government for getting that completed. And I think it's going to be the trade-off is going to be great economics for Canada.
Yeah, I think there was an estimate done. I think it was Deloitte. I don't remember who, but they think that TMX by itself, the expansion, is going to contribute 1/4 point of GDP just to Canada.
Beautiful.
And so, especially given the state that the economy is currently in, I think it's much needed.
Absolutely. Hear to that. So I think we covered that. You also listened, Ernest, to an interesting podcast. We don't just make podcasts; we listen to them. And with one of the greatest capital allocators of all time, Mitch Rales, who started Danaher among other companies. I think along with his brother, right?
Yep.
The Rales brothers. For those, Danaher is their major investment.
Yes. Yes, it is.
One of the world's best compounders. Danaher is not a hard company. It's not an easy company to understand. It's mostly invested in a lot of tools for
Life sciences,
which is something beyond my capabilities of knowledge, but amazing compounder story. So the lessons you learned from Mitch Rales on this podcast.
So the podcast was called The Art of Investing. It's a great podcast. They interview a lot of great business people over the years. But I think Danaher and the Rales brothers have been a tremendous success story. They've built this. I think what Danaher is well known for is their commitment to the continuous improvement. So this is a concept in manufacturing where you look at every aspect and you are very careful about the cost and the budget and trying to improve every aspect on a decentralized basis. I think that's the gist of it.
With the goal of improving returns to shareholders.
Exactly.
Yeah.
And so the Rales brothers implemented this system throughout all of Danaher, and the results kind of speak for themselves.
Is this a Japanese influence or something that they learned from another business leader?
So what he said in the interview is that they got the idea from Toyota when they went on a trip to Japan.
Yeah.
But actually, Toyota got the idea from an American consultant.
Okay.
So they view themselves as having brought it back to America, where it first started.
Interesting.
But I think there were a couple of things that kind of stood out to me.
Mm-hmm.
The first is that he made a comment that compounding is something that just takes time to do, whether it be building a business, whether it be investing. You're not going to get 100 times return or even 10 times return immediately tomorrow.
Yeah.
It's something that you just have to do every day and get a little bit better at on a daily basis. And over time is the results that speak for themselves.
I think Munger and Charlie Munger, God rest his soul, and Warren Buffett would tell you the same thing, that compounding takes a lot of time and knowledge and learning, and that can be applied to all different types of fields.
And so if you think about Basket Wealth, for example, is trying to treat all their customers fairly on a daily basis.
Yeah.
It's managing every interaction with clients, being careful with how we invest on a daily basis, and trying to be a little bit better every day. And over time, hopefully these things are compounding into something great.
That's right. And we want to make our clients rich. It wouldn't hurt if we got even richer ourselves. I mean, that's the goal.
Yep. And so the second thing that really stood out to me, and I hope this informs the rest of when we're talking about Waste Connections, is he said that today, very few companies actually, the challenge for CEOs broadly is that they're just blanketed from the market and analysts for the short term.
Yeah.
The only thing that analysts care about on every earnings call is what you do in the last 90 days. What are you doing for the next 90 days? Why did you miss guidance? What do you think is going to happen in the next quarter?
Yeah.
Right? And that's just not how compounding works. And so what he's trying to do at Danaher with the CEOs and the management that works there is that they want to provide the stability at the board level to encourage their CEOs to think long term, to make sure that they are doing the right things rather than focusing on hitting their quarterly targets.
Absolutely.
And and if you're an investor, I think he said that's what you should be asking. Those are the questions. It's what are you doing to position your business for the long term, rather than, why was your margin like 30 bips lower than the last quarter?
The strong results that you see today from the companies that you own in your portfolio are mostly in part because of the investments and the long-term thinking that your companies did. It's not because of luck. It's not because they beat quarterly earnings guidance in one quarter. It's because they put the time, the effort. They, as Wayne Gretzky would say, they at least tried to go where the puck was going, and that's what we look for in our investments. Yeah, it hurts when you own a stock and it misses earnings, or even if it beats earnings and the stock goes down, and maybe a client will reach out and say, well, why did that stock go down? What's going on? Should we get rid of it? It's no good. Well, we all know price, but we're following what the companies are doing. We've said it many times on the podcast. I'll reiterate it again. What matters over the long term is culture, management, the reinvestment of cash flows, long-term thinking. These things play out. They're not as tangible as making money in the short term on your stock prices, but we're confident that this is the right way to invest for ourselves and our clients.
And so this leads to Waste Connections, which is a company that has a long-term investing mindset.
Yes.
And so following that discussion that we just had, analysts are super focused on Waste Connections margins, gross margins.
Yes.
Right? Whether they are going to get back to pre-COVID, like what's the trend of it in the quarter to quarter. It's a big topic for analysts.
And gross margins, by the way, for those who don't know it, it's revenues minus top line costs.
Yes.
Obviously, higher gross margins or improving gross margins mean that the company's doing something right, usually.
And the reason why analysts pay attention to gross margins is because it has to do with pricing. And so I think what analysts are often asking is, so is the competition, is it picking up or is it slowing down?
Yeah.
But I think if
Do you have to invest more in your business to drive those sales because either your pricing isn't work or you're getting disrupted or it's competition, whatever it's happening?
But the reality is for Waste Connections is there's a tremendous amount of noise that goes into the quarterly margins.
Yeah.
They're impacted by things like fuel pricing. They're impacted by prices for recycled paper. They're impacted by labor price swings. So there's a lot of noise that goes into these things. And so if you're taking a long-term perspective on Waste Connections, I think the most important comment that they made in the most recent earnings call is that their culture is improving. Their employee turnover is back to where it was pre-COVID.
Beautiful.
Their injury rate is at a 3-year low. And I think more importantly is that they're opening up these academies that are designed to upskill workers to help fill jobs. And this is a big deal because, as we discussed in the last podcast, the waste industry is super hard to fill roles.
Yeah.
They're doing this because, number one, it helps them fill roles.
Yeah.
Number two, it's good. It provides good advancement opportunities. And it makes the employees feel good because they're getting training, they're getting a better paying job. And put together, I think this is exactly what you want to see from a company that is investing for the long term.
You want empowered employees. You want employees that have skin in the game, that actually care where they work, that want to improve their company and their coworkers and improve results for the stakeholders. And maybe one day they'll become shareholders as well and benefit. So that type of group think is really good when it comes to improving results. One of the things I found interesting about Waste Connections, a very similar pattern recognition to what TFI International is doing, is they're just not accepting any type of business. So if they win a garbage route or they're bidding on a garbage route, but the economics aren't there, they're going to turn it down. And TFI, the same thing, right? I think TFI, we mentioned on this podcast, that it just stopped doing business with Amazon because the margins weren't there. Even though it could have done a lot more revenue, a lot more business, obviously working with Amazon, which is the biggest e-commerce company in the world and growing, but for the sake of protecting its margins and protecting the integrity, it's doing the right thing, thinking long term. Because if you lose a crappy client and it's a big part of your revenue, that was a mistake anyways to take them on.
Exactly.
Yeah. So please listen to that podcast on Waste Connections. It's called Trash is Cash. I think you'll really like it. So our feature discussion, Ernest, is on Tim Hortons and restaurant brand. I call it Tim Hortons because I'm so old school. Prior to Restaurant Brands being formed, which was the merger of Burger King and Tim Hortons, our clients owned shares of Tim Hortons as a standalone company. Tim Hortons was a standalone company acquired many years ago. My big mistake was actually taking the cash for Tim Hortons shares instead of sticking around. That would have been a much better investment. But we got back into the Restaurant Brands a few years ago, and the turnaround is happening. So, Ernest, today or last night, we saw results from Starbucks. Terrible. We saw the results from Yum Brands, which owns KFC and Taco Bell. I haven't been to any. Have you? Pizza. I can't tell you the last time I've been to a Pizza Hut, a Taco Bell, or a KFC. I have been to Tim Hortons, Popeyes. My kids eat Popeyes. But the brands of yesteryears don't always last forever. But tell us what's working at Restaurant Brands, because it turns out to be very exciting.
Have we ever done a feature on Restaurant Brands before?
I think so.
So
I think we've talked about Patrick Doyle a number of times. So check it out.
So long story short is that Restaurant Brands brought together Tim Hortons, Burger King, and later on Popeyes and Firehouse Subs. The initial thesis was this was before we invested in it, but basically, it was owned by a private equity firm, 3G. Mm-hmm. The whole strategy was to come in, cut a bunch of costs, and milk the cash flows.
Okay.
And that strategy didn't work. Well, it kind of did, but not
Yeah.
really. The brands suffered from underinvestments. Like consumers grew tired with it. The execution wasn't good. There was a story where one story that really stood out to me, where Tim Hortons was launching their loyalty program. This was not even that long ago, and so they tried to copy what McDonald's did in Canada, and it was buy 7 get 1 free.
Okay.
So they rolled this loyalty program out.
Buy 7 coffees.
Buy 7 coffees,
Yep.
get 1 free. And so everybody, Tim Hortons is by far the most dominant coffee company in Canada. So everybody said, this is great. We're getting a coffee for free every 7.
Yeah. I'm going to go anyways.
They're going to go anyways.
Yeah. So stupid.
And so what happened was that comps fell by, I think, 15% because people were just getting an extra coffee for free.
Yeah.
There was no thought into how that tied into the overall strategy.
Yeah.
There was no implementation of digital into that.
Yeah.
And fortunately, they've kind of fixed this now. Now you only get coffee now if you only get free coffee if you do it through the app.
Yeah.
And the rewards are significantly worse.
Yeah. They've devalued the rewards, as all companies do over time. Yeah.
But anyways, that's kind of where Tim Hortons was before they made the management change. So you bring that to a couple of years ago. Patrick Doyle, the CEO, the former chairman and CEO of former chairman and CEO of
Domino's Pizza. Under his tutelage, it was the best performing stock in the whatever index it was in NASDAQ or S&P. Can't remember, but
he came into Restaurant Brands, said he bought a lot of stock. He also got a lot of stock.
Yep.
And he said, we're going to fix this up.
Yeah.
And since then, Restaurant Brands has really changed up a lot. Like the performance is a lot better than what it was. And this is pretty apparent if you look at the earnings from yesterday. Burger King had flat traffic. And this was when McDonald's had negative traffic, right? Some of this is just because they've been shutting bad stores down, but it's still pretty good result overall. Tim Hortons had a mid-single digit comp, which you compare that to Starbucks. It's not directly comparable, but it's quite an achievement considering what Tim Hortons is.
And what about ticket size? The amount of money people are spending at Tim Hortons.
And that's going up too.
Yeah, so that's tremendous versus Starbucks going down.
Yep. They're launching the new food that they're launching for PM.
Yeah.
Such as the egg bites. They most recently launched this flatbread pizza. Those are going well.
Yeah,
and
Tim Hortons
consumers are buying them.
It seems to be a very innovative company, or when it comes to launching new food items, spending a lot on marketing, of course, always coming out with new drinks and new food items. Totally different than Starbucks, which doesn't make their own food, so they don't really advertise their own food. It's not really a big part of their business. But Tim Hortons has now done a great job of getting people to come in for breakfast, lunch, and maybe even PM, right, for a snack later in the day because they have the options available.
And then lastly is Popeyes, which had a 6% comp.
How was that? That's
versus
shocking.
KFC, which is a total disaster.
KFC is a disaster.
Minus 7%.
I would assume KFC is closing stores and in big trouble. Yeah.
And this was attributed to their wings. They've rolled out wings in their store. They did a Super Bowl ad for these things.
I didn't realize that Popeyes is the third largest quick seller of chicken wings.
Yes.
In maybe United States. So that's crazy to me. Yeah.
And to the point about building the business for the long term, they are implementing a new process at Popeyes, which simplifies the operations and makes the service times faster.
Now, that's been the biggest complaint about Popeyes. You're a regular Popeyes goer, and
it's a big deal.
Yeah.
The one close to here once took me 30 minutes to get chicken for a fast food restaurant.
That's not good.
And
it should be at least within a couple minutes or sitting there hot, ready for you, right? They should have an idea that there's going to be traffic every day. It's not a surprise. Oh my God, someone showed up. Yeah.
And I think the most important thing about the good results is that these were all built in the right way. It's not that Restaurant Brands went in and raised the price a lot. is that they were investing in technology. They were investing in like adding new food products that people want to buy. They were investing in at Burger King. They're spending money remodeling the stores where they're getting 15% returns on.
Yeah.
And doing things to draw customers back in.
Ernest, what's your favorite burger? Is it a Big Mac or Quarter Pounder or the Whopper? What would you choose? Gun to your head.
I like Burger Priest.
Burger, well, but that wasn't the option. Okay. Anyway, I really enjoy the Whopper. Try not to eat very many of those because it's important to watch my weight. But Whopper is a very tasty burger. That way, I would choose that one.
That's a good choice.
Yeah, thank you. Okay, so Patrick Doyle, talk about. This is once again where we talk about focusing on culture, on management, on those that think long term, on those that create value. What are the things that Patrick Doyle and his team are doing short term that are planting the seeds for amazing long term growth for restaurant brands?
So the most important thing that Patrick Doyle has done, and keep in mind he's not the CEO.
No.
He's just the executive chair. So,
but he's got a big stake in the company,
yeah.
And if things turn out, he's going to get filthy rich. He's already filthy rich, but he's going to get filthy rich times 2.
So he is not the guy that's actually making the actual decisions.
He's the guy behind the guy?
He just sets the tone.
Okay. All right.
Kind of like, I don't know if you saw in the news this week that apparently Bill Gates is still pulling the strings at Microsoft.
That's what I also saw that headline on Twitter, that Bill Gates is still. Why not? Why wouldn't people still? He's a genius.
Exactly.
He's founded the world's greatest company. You should, and he's not that old a guy. You know, people should be referring and talking to him at Microsoft all the time, and he still has a healthy stake in it through his foundation.
Yes.
Okay.
But back to restaurant brands. Mm-hmm. The most important thing that Patrick Doyle has done is to focus the business on franchisee returns. So what this means is that all the decisions that are made, whether to launch a new food product, how you promote the business, whether you spend money on remodeling or digital kiosks, all these kind of things are determined based on whether they add to franchisee returns. Is the franchisee going to make more money because of this in the long term? And this was not the case before Patrick Doyle was in.
No, there's articles in the Globe and Mail regularly how Tim Hortons franchises hate the parent company.
Before, they would make all sorts of decisions that benefited the parent company at the expense of franchisees.
Yeah.
So this has changed substantially. And the reason that this matters is because, number one, if your franchisees are making money, they're going to be more willing to invest in the business and open new stores. So it's good for the business overall. You
want an owner of a franchise not to just own one store. You want them to own multiple stores. And the only way you can convince them to own multiple stores is if their current store is doing better than they thought. And it wasn't, but things are turning around.
Yeah. And so that's the big change that has been happening at Restaurant Brands, is that at all of these brands, what they've done is they are implementing an entire culture of focusing on franchisee returns.
Yeah.
The second thing is to only focus on the franchisees who want to participate in this journey.
Yeah.
There are a lot of franchisees who are there. They don't want to invest in the business. They just want to milk the cash flows. So they got rid of all these franchisees. They took a page out of the Rail Brothers, actually, and implemented ABF benchmarking.
Okay.
So all restaurants are rated on an A, B, or F scale.
Okay.
If you're F, you either have to improve the business or sell.
Okay.
Or shut down.
Yeah.
And
if you're B, you better get to A.
Yes.
Yeah.
And it's only the A's that are going to be allowed to invest in the business, open new stores going forward. This is something that was done at Domino's to great success, and it's something that's happening at Restaurant Brands today. And so you put these things together, and from that flows all the initiatives, such as the Burger King remodels, the pizza at Tim Hortons, right? And I think it's going really well if you look at the results relative to competitors.
And unlike a Starbucks, which is a high-end coffee, in tough times now with inflation and high interest rates, and the consumer may be turning the nose at it, I think there's good value in the products that Restaurant Brands sells across its board. It's whether or not you like the food, we could talk about it on another podcast. But the bottom line is it's offering good value, and that should drive good traffic and nice looking stores and improve speed. All these things work together, and the company's planting the seeds, investing in these remodels. Of course, it's depressing earnings in the short term, but they're not going to meet the guidance that someone wants if they're investing in the stores to improve, but that's going to improve traffic going forward. And remodeled stores are clear. They do drive traffic, and a remodeled store looks pretty good for 5-10 years. That could do the job. So that's all the time we have for you this week. We'll see you back here real soon. And thank you very much for joining us.